market dipped quite savagely at one point, down about 1.4%. We certainly saw a bit of a turnaround.
Not a bad performance by the Aussie market, down by 0.5%. And as you mentioned, James, this morning, the focus really was on the region and also on currencies. We've seen a pretty dramatic move in a lot of the emerging market currencies, and that's really because of tapering expectations, the belief that the end of cheap US dollar funding is coming to an end. So in particular, it's those economies with very high current account deficits, such as Indonesia and India, that have been very much in focus. But of course, at 11:45 a.m., what we saw was the focus turning to China. We saw this flash HSBC PMI numbers coming out. This is the first insight that we get into the manufacturing sector in China for the month of August, and it was a good one. Now, this is on top of export numbers, import numbers, industrial production numbers that have recently been beating expectations. So the numbers coming in ahead of expectations, 50.1. So looking at expansion in the growth of the manufacturing sector, and beating expectations for a read of 48.2. So that helped boost the Australian market, and we ended down 0.5%. Some good volumes going through the market today as well.
Hey Julie, afternoon, it's Martin here. How are you?
Good, how you doing, Martin?
Yeah, surviving this reporting season.
Aren't we all?
There's so much information. Look, I just thought I'd touch base with you on one thing, which is really interesting. We keep looking across the news wires, and you've just mentioned it, this constant fixation in regards to tapering. Now, surely the markets have been well and truly given the heads up by Ben Bernanke and the Federal Reserve that tapering is going to commence at some stage. They clearly indicated that they're not drawing a line on any one particular economic number. There has to be a whole range of numbers that will allow them to start tapering because the US economy is going well. Why do you think it is that there seems this big focus on, and why are markets nervous about it?
Well, the markets are nervous, I think, for two key reasons. One is the long-term US Treasury yields moving upwards, and we've already seen that starting to happen. And that really means that funding costs in the US are higher, and also a lot of the Asian countries which do rely on foreign funding, well, it means that's going to be more expensive as well. And so I think part of the story is the longer-term yields in terms of US Treasuries, which are moving upwards, and the other one is I guess the fact that we've seen $85 billion being pumped into the US economy every single month for the last few years, and now, you know, the market's starting to price that coming to an end. Yes, the US economy is looking stronger, but the belief is that a lot of that money didn't really find its way into the US economy, but into asset markets around the globe, and really help to support prices like commodities and like the US stock market. So with tapering coming to an end, yes, we might be seeing a stronger US economy, but I guess the market's getting a little bit jittery on what's going to happen to market performance once the drips are turned off in terms of quantitative easing. So my own belief is that the quantitative easing, the FOMC meetings, are going to resemble more the traditional FOMC meetings, where they decided on what the cash rate in the US would be. But instead of deciding on the cash rate, what they're going to decide on is how much quantitative easing is going to happen in the month. So we might see an adjustment from $85 billion maybe to $70 billion. And if the US economy gets worse, we might see it being raised up to $90 billion. But I think it'll be an adjustment every month. But the market's a little bit jittery, given that we have been on quantitative easing now since the global financial crisis.
Yeah, look, Mark, a growing focus on domestic cyclicals. Certainly I know from Macquarie's perspective, we aren't holding a single domestic cyclical in our recommended portfolio yet, and certainly been waiting for this reporting season. So it does seem to us that the earnings cycle has troughed at the moment. So it's quite interesting to be looking at the likes of building materials sectors, transport sector, and retail space. Are you guys doing the same? Are you looking at that space at the moment?
Well, I think this space has already started to run. If we have a look at the cyclicals, they started to run around about 8 months ago. So I guess a lot of investors already positioning themselves for a turning in terms of the cycle. And often when we talk about cycles, we look at 3 different cycles. We look at the share price cycle, or the share market cycle. Secondly, we look at the earnings cycle. And thirdly, we look at the interest rate cycle. I guess in terms of the interest rate cycle, it does look like the cutting of rates is coming to an end. And while we're not expecting to see interest rates rise anytime soon, and we are expecting to see it remain low for a period of time, it does look like the cutting cycle there coming to an end. We have a look at the earnings cycle. We know that's been negative over the last last few years, mainly because commodity prices have been falling so much. But it does look like that's bottoming out now, and it does look like in FY14 that we're going to start to see some positive earnings coming through. But of course, if we have a look at share prices, they move ahead of all of this because share prices are forward-looking. So even before we've seen the earnings cycle turning, even before we've seen the interest rate cycle turning, the share market cycle has already turned. So if we have a look at the cyclical, prices have already been running. So if we have a look at stocks like JB Hi-Fi, up 100% over the last 52 weeks. Even the building product companies that have come out with fairly dismal earnings, especially because of the residential construction and non-residential construction area, they've still got positive performances over the last 52 weeks.
On that note, we're going to have to leave it there and let you take a breath, Julie, and gear up for tomorrow. Thanks very much.